And I think that just given the ongoing slow-moving fiscal crisis, I mean, you're running something like 7% of GDP deficits before a recession even starts. It's pretty hard to have a disinflationary recession when there's just outright that much fiscal deficits pouring into the economy before it even starts. That doesn't mean you can't have, kind of an inflationary or kind of stagnant type of economy. And that's why I think having experience with emerging market recessions is probably a little bit more instructive for what this could look like.
Returning today to the show is Lyn Alden, founder of Lyn Alden Investment Strategy, a fan favorite. We'll be talking about our new book, Broken Money, and what's going on in the markets today, and an update to her macroeconomic outlook. Lyn, welcome back to the show. Always good to see you.
Happy to be back. Always happy to be here.
Let's talk about your book. It's called Broken Money, and we will be talking about some of the themes of your book as well as how it applies to our monetary system today. But first, I want to touch on what's going on currently in the markets. As you know, volatility in the yields and the long end of the curve, especially. I'm just reading an article from 4 days ago. U.S. bond funds rack up biggest weekly inflow in 3 months. This is from Reuters. U.S. investors poured a massive sum into bond funds in the 7 days leading to November 8th on hopes of a turnaround in Treasury bond prices following the Federal Reserve's decision to keep interest rates unchanged. A report from the U.S. Labor Department indicating a slowdown in job growth in October also lifted bond prices last week. So a lot of volatility in the bond markets, like I mentioned. We hit 5%. Now we're below that. Can you give us a summary of how bond investors are feeling about the markets right now?
So I think overall we're seeing a little bit more signs of recession pressure. It's been much delayed, and we're still not seeing really acute signs of recession, but the labor market is getting softer. But I think, the actual result is a little bit less narrative driven than that. I think a lot of it is just rebalancing. We've had such a historical bond bear market. I mean, the absolute worst performance since George Washington. We've Treasuries have never done this poorly, right? So it's been this awful period for bonds. And especially given the multi-month really sharp sell-off they had, it's natural for some large portfolio investors to rebalance, especially on a quarterly basis, to basically lean into the fact that the bonds underperformed and to maybe sell some of their Mag 7 stocks that have just gone straight up. And so I think to some extent, once those yields get that high, they become somewhat more enticing and they help encourage that type of rebalancing. So I think we're seeing some of that. I'm certainly less bearish on bonds down here than I was, over the past few years. I've generally been in the bond bear market camp. Um, but I think that the bond market is still not out of the woods yet. If you look forward, the amount of supply coming is basically just endless, right? So we have like $1.8 trillion deficits and growing as far as the eye can see, with very like unlikely ways to address this. If we do get a recession, the interest rate component could relax a little bit, but then other parts of the deficit tend to blow out in a recession. And so there's really kind of no path forward realistically for addressing these deficits. And so I don't really still love the long end of the bond curve on a risk reward trade. I mean, I think it's potentially a tradable asset at these levels. But I think if someone's interested in the bond market, I think the tips are interesting. 5 or 10 year tips are pretty interesting here. Some of the 2 year treasuries are pretty interesting. There are certainly attractive parts of the curve. And I think that's what investors are seeing, that basically some of these assets have become more attractive and have encouraged some degree of rebalancing.
Are you expecting a further reduction in the 10-year yield then following this point?
I'm very neutral for the next 6 months. Basically, that the sell-off was even worse than I thought, despite being a bond bear. So it exceeded my expectations to the downside within the time frame at least. So I wouldn't be surprised to see it just consolidate for a number of months. For me, the long end of the curve right now is just in the too hard pile. There's, as Stan Druckenmiller would recall it, there's no fat pitch here, right? There's no like easy hit. It's not easy to say if it's going up or down. And so for me, it's just like why play in that market when there are other more interesting markets? Whereas on the other hand, I think that real yields on tips, it's gonna be hard to sustain them at that high real yield level. So I do think that tips are a more kind of higher conviction longer term view, and you generally take on less duration risk. So, the 5 or 10 year tips I think are good enough. You don't have to go out longer.
Okay, I'm just going to pull up the tip chart here. And it seems that inflation expectations have deteriorated given the direction of the chart. Is that in line with what with what you're expecting, which is inflation to come back down
So
further?
we're seeing mixed inflation expectations depending on what you look at. So break evens are not that high, but for example, Michigan survey has showed a little bit of an inflation expectation breakout. My general expectation is, next 6 months, it's really kind of decide between this recession or this ongoing fiscal stimulus. Whether or not recession dies down could be determined by very specific geopolitical events. Like, for example, if the war in the Middle East expands and there's some sort of oil supply disruption, that would send inflation right back up pretty quickly. Whereas if you don't get any of that and you do get a U.S. recession, you could see pretty muted inflation for the next 6 months or so. But my overall longer term view is that whenever we try to have another growth cycle, so whenever we don't have PMIs going down, whenever we have another reacceleration, inflation forces are still generally there. The very large fiscal deficits, the tight energy supply, the tight labor market. I think that's going to be a recurring theme. So, like prior inflationary cycles, it usually comes in waves. I expect that to happen again. So, for me, the less interesting call is about the next few months, and the more interesting call is basically just that I don't, still don't really like. The real purchasing power of long duration bonds here. But tips are interesting because, if you do get a recession, probably real yields come down, which is good for tips. If you lock them in now, if we do eventually get another inflation breakout, tips give you some protection with, basically a real yield above that, kind of CPI. And so it might or might not keep up with quote unquote real inflation. But on a risk adjusted basis, I think it's one of the more interesting places to have conservative capital at the current time, alongside other more direct inflation hedges like energy stocks or things like that. So I still have a generally inflationary outlook in the longer term. And I express that mainly through having tips in energy stocks and Bitcoin and assets like that.
Do you expect unemployment to go up even higher from 3.9%? And second, could we see a soft landing despite higher unemployment?
So I expect it to probably inch up higher. I don't think we'll see the levels of unemployment that we saw, for example, in the 2008 crisis. I think in many ways the 2001 recession is instructive here, which is that by most metrics that was a pretty mild recession. I mean, if you just look at the stock market, you would assume it was severe, but that's because equities were in a bubble. When you actually look at, what did GDP do, what did unemployment do? That was a fairly mild recession. And I think because of the tightness in the labor market and the ongoing large fiscal deficits, which are stimulatory, it's pretty hard to have a very deep recession. I don't love the phrase hard landing, soft landing, because I think that somewhat misses the point. I've described it as an emerging market landing. If you look at recessions in emerging markets, they tend to be a little bit different than these disinflationary recessions we're used to in the developed world in the past kind of 40-year structural disinflationary bond bull market. Generally, when you have emerging market recessions, they're more stagflationary. And some of the nominal numbers continue to surprise to the upside. If you just look at what's happening to the economy in their local currencies, things are generally still going up, even as you look at things in dollar terms or gold terms are not doing well. And I think that given the ongoing slow-moving fiscal crisis, I mean, you're running something like 7% of GDP deficits before recession even starts. It's pretty hard to have a disinflationary recession when there's just outright that much fiscal deficits pouring into the economy before it even starts. That doesn't mean you can't have, kind of an inflationary or kind of stagnant type of economy. And that's why I think having experience with emerging market recessions is probably a little bit more instructive for what this could look like. But again, right now the PMIs are showing kind of intermediate. They were starting to bounce. They were starting to show actually kind of potentially a bottom. Almost something you could call a soft landing. But the latest reading has been pretty weak. The labor market's still weakening, and so I think that we're seeing these ongoing forces. So that the Fed's tightness is putting downward pressure on interest rate sensitive industries. So residential real estate, even though the prices have held up, the turnover has stalled. Commercial real estate's under severe pressure. Small businesses are under severe pressure. Basically, any company that has fairly short duration debt that has to refinance, even just by holding interest rates here, that's going to get harder and harder on them because more and more of that refinances every quarter. On the other hand, this is offset by the fact that the US government's in the same position. The average duration of their debt is only about 6 years, and a lot of that is front loaded. So they go up to 30 years, but a lot of that's like at any given time in the first, kind of year or two. And so they've had to refinance up to these very high interest rates, and someone is earning those interest rates. That money is pouring into the economy, in a certain way. And so we're seeing kind of like very loose fiscal policy, which is stimulatory and inflationary, and we're seeing very tight monetary policy, which is recessionary and disinflationary, and they're kind of at like a stall speed right now. So I think that that's probably going to continue for the next quarter or two.
Sorry, can you just back up a minute? So deficits and inflation. Can you just outline the assumption here? Why higher deficits will necessarily mean higher inflation? What's the assumption here?
Well, in a vacuum, it's inflation.
Oh,
It
okay.
depends how disinflationary the other forces are.
Right.
So we saw, for example, during COVID, I mean, this inflation wave we saw in recent years was not because of excessive bank lending. It was because of very large monetized fiscal deficits. If you just give everybody money, they spend it, and if there's only so much supply due to constraints, you get inflation. Now, what we're seeing now is a different type. So instead of handing out money with stimulus checks or PPP loans to turn into grants, we're seeing just higher and higher interest expense. In addition to, I mean, Social Security had to adjust upward due to inflation. Medicare is also basically inflation adjusting. As healthcare inflation goes up, Medicare outpouring happens, and so as we see the very large baby boomer generation retire and start collecting these benefits, and therefore continue consuming without being in the labor market anymore. Um, Basically, there's just a lot of consumption happening, fueled by these deficits, compared to the amount of supply that's being created. And interest expense and these other things don't have as high of a propensity to spend as stimulus checks or PPP loans that turn into grants and that kind of thing, but they still have a non-zero amount of propensity to expend. I mean, probably the quintessential example is if you're a upper middle class retiree or near retiree in your 50s, 60s, 70s, and you've got a decent amount of assets. You're in money market funds, you're in T-bills, um, and you've got either a low fixed rate mortgage or no mortgage. The higher interest rates go, or the higher this federal government's kind of pouring out interest expense, you're actually getting more income. Your liability side's fine, and you're getting more income, and so you're going to restaurants and you're traveling, and when your kid's struggling, you're kind of like helping them get into their home or paying for their wedding or whatever the case may be. And it's not as jolting as like a stimulus check, but it is still a type of money that's basically pouring out from the federal government into the private sector economy. It's pouring in towards the top end, which still does get out into the economy, just slower. It's kind of a slow burn.
Is that partly what explains the ever increasing higher advanced retail sales?
Yeah, I think that is fueling a lot of it. I mean, basically, restaurants have been fine. Retail's been mixed. It depends on what type of retail, but that's all, we're seeing there's been a slowdown in manufacturing. There's been a slowdown, obviously, in real estate and things like that. But service sector's still been decent, especially anything that caters to people that are on the right side of the deficits. So when you look at industry by industry by industry, you have to ask yourself, is this industry on the right side of the deficits, or is it on the wrong side of the Fed tightening? So that's also why this recession can be somewhat different in the sense that with two very like the fastest Fed tightening cycle in modern history, but also the loosest fiscal environment in modern history, it means that some industries are almost booming and other industries are in recession already. And so you have a tale of two economies, a bigger divergence than the average economy, which would be if we had, say, smaller deficits and less tightening, right? We have two very big divergences here.
So bottom line for next year, are you expecting low GDP growth or negative GDP growth for some quarters?
I don't know. I think we have low real GDP growth. I would not be surprised by negative real GDP growth. I think nominal is probably still going to be highish. And so I think that it's more of like that emerging market style industry specific recession, which also in emerging markets, like for example, you can have an environment where the exporters are doing fine, even as the domestic economy, businesses are suffering. So you get a bigger divergence there than you get in developed countries. And I think that that's kind of what we're seeing, except instead of exporters, it's basically whether or not you're benefiting from the deficits or whether or not you're hurting from the Fed tightening.
And are you expecting a Fed cut by next year as well?
Um, if the economy gets severe enough, I do think that they would cut. Right now, the market's pricing in very mild cuts, and I think it's probably more Boolean than that. Like either we're not going to get a cut or we're going to get several cuts, and that depends largely on the labor market. If we start to see unemployment get over 4.5% or so, I do think you see more rapid cuts. Um, but yeah, again, that's none of this is like a fat pitch at the current time. Whereas there are other parts of the market that I find more interesting. So I think that we're still in this kind of purgatory. We're in this kind of like limbo state where these two very powerful forces are making a very kind of unclear situation.
Are you bullish or bearish on the emerging markets right now?
So it depends on the emerging market, but for example, I find a number of opportunities in Latin America, including Brazil, Mexico, and elsewhere to be interesting. And there's a couple of reasons there. One is that and this is not recent, but over the past several years, there's just so much global capital stuffed into U.S. markets. Basically, it's just U.S. Economy is 4% of the world population, 15% of purchasing power GDP, 25% of nominal GDP, and 60% of global equity market capitalization. Um, there's just so much like the businesses are doing better, but then also the valuations are higher. There's tons of capital stuffed in. And basically, emerging markets are on no one's radar anymore. Now, I think that we can't just look at a whole basket of emerging markets because China is somewhat different than Brazil, for example. I think you have to kind of take them as individual countries. And if you look at Latin America, first of all, it's far away from any of these potential World War III like catalysts. So it's not in Eastern Europe, it's not in the Middle East, it's not in the South China Sea. So any sort of escalation in kinetic activity, Latin America is kind of on its own in a good way. Um, Many of the countries there have commodities, including Brazil, and I think this is going to be a commodity bull market. The valuations are very low. Basically, there's just no capital interested. Everyone just piled into the Mag 7. Everyone is just kind of focusing on these other markets and just they've been left for dead. And then there's an interesting virtuous or vicious cycle with emerging markets, which is because they have dollar-denominated debt um, things that have nothing to do with them can squeeze or relieve their debt based on just capital flows. So, for example, if a ton of European capital decides it wants to be in U.S. markets, right, and it just piles into Mag 7 U.S. equities and drives up the dollar, that can squeeze, for example, a Brazilian company's dollar-denominated debt or the Brazilian country sovereign dollar-denominated debt. And so something that's just not related to Brazil, they're getting squeezed by that the fact that there's so much capital that wants to be in the US. Should we get any sort of reversal there? For example, the prior reversal was after the 2001 recession. So during that period in the 90s, US was booming, all the capital poured in, emerging markets suffered, especially Southeast Asia. And then eventually, when we encountered recession and cut interest rates and basically alleviated our policy to somewhat, capital flew out. And then you get kind of that double whammy, but in the other direction. So instead of that vicious cycle getting worse and worse and worse, if more capital then looks at Brazil or looks at elsewhere and says, actually, that's super cheap. And if around the edges, capital flows out of the US and towards them, not only does it benefit their valuations, but then it gives them that fundamental boost of relieving some of their dollar denominated debt. And so if you look at Brazil, I mean, they have low valuations, high real yields, a very strong trade surplus at the current time because of their commodities, enough stability for now, basically just given, it's an emerging market, you got to manage your position sizes. And so I think there are constructive areas there. If you're looking at the Mag 7, you don't love the valuations. If you're looking at the bond market in the US, you're thinking, yields are high, but there's so much supply coming. There are other markets out there in the grand scheme of a portfolio, you can put, say, 3% into this country, 3% into this country, X% into certain commodities. You can diversify outside of that 60-40 kind of US centric portfolio.
I'm a little bit surprised you picked Latin America, given very high inflation rates in several countries in Latin America, hyperinflation in some, for example, Venezuela, Argentina, Chile, also 50% inflation. Is the assumption here that foreign investors or capital flows into the country wouldn't be affected by domestic inflation?
So I think it depends. Mexico and Brazil have inflation more under control than the others. I'm not, it, basically there's sanctions against Venezuela, and it's just not. So I'm not interested in that market. Argentina is more of a mixed bag. We'll see what happens with the upcoming politics. Basically, at a certain point, you can hit rock bottom, and some of those equities can be actually extremely enticing if there's any sort of stabilization or turnaround. Um, but for me, kind of Brazil and Mexico are the most interesting markets, probably followed by Argentina and Chile.
Okay. I want to talk quickly about Bitcoin and then move on to your book. So, Bitcoin, huge runs in the last 4 weeks, really. Divergence from the NASDAQ, which is something that is not common, but it has happened several times in history throughout history. Is this just fully pricing in the Bitcoin ETF expectation? Is that what's happening?
So I think that's part of it. That affects timing. Another thing we're seeing is that if you look at Bitcoin price compared to global liquidity, and for that metric, I use global broad money supply denominated in dollars. And that's affected by one of two main ways. Either money supply is expanding because of either money printing or credit creation, or the dollar is weakening, right? And so when the dollar is strengthening and credit is drying up, global liquidity is going down, and when the dollar is weakening and or credit is expanding, global broad money, global liquidity is going up. And Bitcoin is very highly correlated to that. Um, and so if you look at that, it's arguably more correlated to that than even its own halving cycle. But that's another variable. So early, in spring of 2024, Bitcoin is having another supply halving, meaning that the number of new coins generated every 10 minutes will get cut in half. So you have a supply shock, while demand is still pretty steady, and the spot ETF could potentially drive more demand. If you get the blessing of BlackRock, if you get these just easy ways for existing trillions of dollars of certain types of locked up capital to have a liquid vehicle to go in that's better than the futures ETF, better than the grayscale product that has like fluctuating premium to NAV and all that. If you actually get a better product for them, plus the overall kind of green light for some of those pools of capital to consider it a serious asset, that could be a demand shock. But even without that, I just think that generally the next 2 years, let's call it, of decent liquidity and a halving is attractive. So it's almost like I view this as like a bell curve where like the classic like midwit meme where like someone on the left of the bell curve is just like buy the orange coin, and then the person on the right is just like it's the best asset ever, own it, and the person in the middle is finding every reason not to own it. They're like, no, there's a recession coming, or no, and you can have all the list of reasons why it might not go up. But I'm kind of looking at it as like just the classic bell curve thing where I think the next 2 years is supply going down and probably demand being flat to up, which should be constructive for price. Now, it's come very far in a short period of time. I mean, this, it could fall 20%. It could retest its 31,000 breakout. It could go sideways for 3 months in a choppy band. But basically, I just think next 2 years, pretty high conviction that it goes up.
It's interesting because Bitcoin has never in its history seen it having during a recession. I'm not saying for certain we're going to get a recession next year, but suppose we do, this would be the first time it's happened in its history. Which would you think would be a stronger force, the halvening, or a recession, which would pull down risk assets? All
So
else
I think
being
that,
equal.
yeah, so I think that depends on the type of recession. If you get actual liquidity shock, like this worst part to 2008 or during COVID, if you get an outright liquidity shock, pretty much all assets go down, except for the dollar. And so gold will go down, Bitcoin will go down, equities will go down. A lot of even long duration bond yields in those extreme environments can go up, meaning that even bonds can sometimes go down in those environments. Um, and so if you do get something like that, that would override almost certainly anything Bitcoin specific. But again, because I view this as more an emerging market style recession, with just these massive deficits pouring in, um, while I don't rule out those types of liquidity shocks, I do think that the halving and the ongoing kind of liquidity situation, and then the weaker dollar, or at least the reduction in real yields we probably would get in a recession, would benefit Bitcoin. So I think that in that recession, at least outside of brief liquidity shocks, I think assets like gold and Bitcoin, they don't have to worry about earnings, and instead are mostly liquidity plays. I think they'd likely do better than stocks in a recession environment, would be my base case, especially when you throw in supply having ETF potential and these other factors.
So bottom line, for the next year in 2024, your most bullish assets, are you then expecting Bitcoin, commodities, and things like gold and energy to outperform the stock markets?
So I think Bitcoin will. I think that energy, next 6 months, if we get an outright recession, I think energy could be in line with or even slightly under the broader stock market. My energy view is less about the next 6 months, next even 9 to 12 months, and more pretty high conviction that it outperforms with a 3 to 5 year view. And I'm not really trying to trade it. It's just like the valuations are inexpensive even at current oil prices. So basically, it's a positive carry view on eventually having a kind of supply side driven energy bull market. And so different time frames for these different assets. So Bitcoin, I'd be pretty convicted in a 2 year view. Energy, it's a little longer than that. Same thing for emerging markets. I think it's, if you look at Brazil, for example, you're getting positive carry, and I don't know what happens the next year, but I'm pretty confident with at least with cautious position sizing of how it's going to do in a multi-year period. So, different time frames, different assets.
Congratulations on your book launch. Came out earlier in the summer or later in the summer. Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. A big question that a lot of people have been wondering, of course. First of all, what inspired you to write this book?
So a number of things. One is that I've just written so much long form content in the past 5 years, and I've done so much research that it can be hard for someone to get into my work in a way. And so this is a product that I can, if someone wants to kind of get my complete thoughts, or at least a big chunk of my complete thoughts, I can just say, okay, read the book, Broken Money. That will get them there. Number two is, I travel to different countries. I live part of the year in Egypt every year. I have family and friends there. That's my second home. And I live in the US. And so I kind of just see on the ground what's happening in some of these different countries that I just don't see discussed enough. And then lastly, I just kind of come at this with a different view because, a lot of books about money, especially like the history of money, they often look with a political lens. Like, what did this political leader decide about money, and how was this formed, and what were the political decisions there? Whereas I felt there was a gap, like basically not enough people taking an engineering view or a technology view towards money. And so what my book does is it looks at the past, present, and future of money through the lens of technology. Like, how do certain technologies change either what we use as money or how we interact with money? And so that's a big theme throughout my book.
In your book, you've discussed several problems with the current monetary system, and you've also discussed potential solutions going back to history. You've talked about the gold standard in one of your chapters. Um, we had the gold standard, several iterations of the gold standard. We no longer have it. Is it important for us to anchor our monetary system to any commodity, whether it be gold or perhaps Bitcoin, some argued, or any hard asset? Is that the solution to some of our monetary problems today?
So I think the problem with anchoring is that anchoring is destined to break. Anchoring is a decision. I think these things generally have to work from the bottom up to be longer term successful. And so if you look at kind of the two paths of technology for money, there were two simultaneous things that were happening. So the first is that humans have used different types of commodity money throughout history. That's kind of what dictates the scarcity of money. But as our technology got better, as our mining got better, as our tools got better, we got better and better at making certain types of money. So, for example, we could make all the shell beads we want. We could make all the tobacco money we want. We could kind of inflate all these other types of money. And so we kept narrowing towards the hardest types of money to make more of, which are, silver and gold, and precious metals in general. And so that was kind of one path of technology. The other one was our ongoing development of banking. So People don't think of them as technology today because they've been around for so long, but paper was a technology, bookbinding was a technology, analog encryption techniques, like how do you make a receipt for an asset that can't be easily forged, for example? That's a type of technology. The printing press was a type of technology. So as we kind of develop these different technologies over time, we became better at the technology of banking or abstraction or bills of exchange, the ability to kind of transfer value more quickly than transporting and verifying physical gold. Um, but it was really the telegraph that blew that open. And so with the telegraph, especially the adoption of the telegraph, we got to a world where different ledgers around the world could send signals to each other at the speed of light to update their ledgers while gold was still in the physical realm. And so it's kind of the first environment where speed mattered as a commodity variable rather than just hardness. And so what we generally saw is that in that environment where transactions can go at the speed of light, settlements can't, we we lean on greater and greater levels of abstraction to bridge that gap. So the only thing that can go quickly like that is credit. And so we just get more and more credit based, and eventually governments were able to just kind of like first they consolidate all the gold and then they just drop gold entirely. They just leave it as a reserve asset on their balance sheet. And the challenge there is that gold is useful as a savings asset, but it was not powerful enough to kind of keep banks honest. If you have fractured reserve banking built on top of gold, you're just going to eventually break your peg. And that's what we saw not just in one country, but every country, everywhere, and so far permanently. Um, I think going forward is what's interesting is that for the first time since the creation of Bitcoin and then some other assets as well, we have near instant settlement. So for example, I can send you money over like if you showed me a QR code on this video call, I could send you money and it's a bare asset that goes from my address to your address. And it settles in, a few blocks of transactions. And it's not based on ongoing credit. As long as the network itself is still decentralized and intact, that is a final settlement for all intents and purposes. Um, and if we were in different countries, it just goes around any sort of financial borders we have. So, for example, I know a videographer in Egypt, and he charges to foreign clients in dollars to do like on the ground kind of filming for them. He charges in dollars, but by the time they pay him, it hits his bank account in Egyptian currency. So he has to then put it into something else. Whereas if I have a Egyptian graphic designer or a Nigerian graphic designer or a Philippine graphic designer, or a videographer, whatever the case may be, I could pay, whatever currency they want. Maybe they want Bitcoins, maybe they want dollar stable coins. There's even gold-backed stable coins. Whatever currency they want, I could pay them with a QR code. I could pay them if they send me an email or a DM, I can just pay them, go around their local banking system and pay them the asset that they want to have.
They'd
Um,
still have to off ramp to the local currency, right?
Potentially, but
Yeah.
for example, I know someone that just got his car repaired in Costa Rica with Bitcoin. There are these increasing hubs around the world. So South Africa has a community, Costa Rica has a community, um, Guatemala has a community, Indonesia has a community. There are all these kind of different communities popping up where there's actually a decent amount of circular economies. There's also a decent amount of ones that receive stable coins, right? So in Argentina or Turkey or Lebanon, there are some vendors that will accept stable coins. And so you could, if you wanted to, convert them to your local currency. The good news there is that you get the actual exchange rate. So for example, if you go through a bank and if someone converts dollars to the local currency, they're going to get the official exchange rate, which is often a lot worse than the street rate. Whereas if you convert some of these peer-to-peer assets into the local currency, because there's that quote unquote physical nature of it, they actually get something closer to the official exchange rate when they do. So even if that's the only benefit, that's a big benefit. But aside from that, sometimes they can just use the asset themselves to pay for something and give it another 5, 10 years of liquidity. And I expect that to probably keep growing. There are thousands of points across Europe where you can recharge your electric vehicle by paying in sats in Bitcoin. I think that it's so far it's around the margins because, especially in the developed world, we generally have decent payment mechanisms. And even in an emerging world, if you can convert your currency to the local currency at the better exchange rate, you've already solved a big chunk of your problem. But I think that those circular economies are going to likely keep growing. And the point is, you can now kind of just go directly peer to peer. Another thing you can do is you can memorize 12 words or write those words down and bring infinite value density with you anywhere in the world, right? So for example, if I want to bring bearer assets with me through an airport, cash or gold, I'm going to be limited to like 5,000 or $10,000 worth. It's very hard to bring kind of meaningful value. Also, bank wires are heavily controlled, but if someone wants to leave country X and go to country Y, if they have Bitcoin, they can just memorize 12 words or write them down. And I mean, if you had it, you could bring $1 billion through an airport. Um, or more realistically, just whatever you have, you can bring it through. And so the infinite value density through ports of entry, plus peer-to-peer payments around national banking borders, with Bitcoin, stable coins, multiple asset types, really just kind of cracks open the kind of siloed nature of the money system. And it's really only been in the past few years that the liquidity has been big enough to really matter. And so I think give it two more cycles and it could be kind of interesting.
Would the volatility of Bitcoin not frustrate you as a former, if you consider it a form of payment? Suppose, let's say you had clients who would pay you in Bitcoin as opposed you, I don't know, hypothetically charge half a Bitcoin for your services. Would you not feel compelled to adjust your prices, or in this case, your unit account, which is in Bitcoin, every day because of its value relative to fiat?
Well, that's why stablecoins have been rather popular, is to adjust for that. I think that's mostly a timing thing. So you can't go from a $0 asset to a multi-trillion dollar market cap asset without upward volatility. And with upward volatility is going to come leverage and then downside volatility. So I think that there is like a, 20 plus year kind of time where it's getting closer to its total addressable market. Um, and the way that kind of liquidity works is it's sort of a network effect, and you can't even reach higher levels of that without the prior one. So, for example, when Bitcoin had thousands of dollars of trading volume, if one millionaire wanted to exit the market, he can move the price, right? It's just not liquid enough for him. But over time, once it got up to millions of dollars of trading volume, one billionaire or one entity could move the market by entering or exit the market. Again, not enough liquidity. Now that there's billions of dollars worth of trading volume, there are still very large pools of capital, tens of billions or hundreds of billions or trillions of dollars pools of capital that have the ability to move the market. And so I think that, you have to get up these higher levels of liquidity. You have to 10x the adoption rate around the world, and then you get a more liquid and less volatile market. And so I think that in the near term, Bitcoin is basically still a savings asset. So it's primarily meant for people that want to hold it for 3 to 5 years rather than kind of keep it as their short-term cash balance. And so, for example, you'll see cases in Argentina where someone says, okay, I have local currency for the next month, I have stable coins for the next 6 months, and I have Bitcoin for the next, multiple years. And that's kind of how they manage their checking versus savings accounts, more or less. And I think that's stable coins are a useful bridging tool, and they are particularly popular in non-US markets for that reason.
All right. Final point on your book. Now, in one of your chapters, you said, and I'll just quote this paragraph: much analysis on inflation decries the printing of money by governments and central banks. And indeed, money printing is something that occurs frequently in the modern era. But similar attention must be paid to the centralized destruction of money. What did you mean by that? Why is it happening right now?
So sometimes deflation gets a bad rap, because there are periods of monetary hardness or deflation that became unpopular or caused problems. And so I think we have to separate kind of there's different types of deflation, right? So there's technology-driven deflation, which is good. Like we like the fact that a gigabyte of storage got 1,000 times cheaper because that's what allows us to have 1,000 times more space. Like I can have a terabyte drive instead of a gigabyte drive because it's gone down by orders of magnitude. That's a good type of deflation. And I would like to see that more and more. I would like to see energy prices go down. I would like to see all this other stuff go down due to better productivity. The problem is that when people think of deflation today, we're such a leveraged economy that if you have deflation for a period of time, you get this kind of vicious cycle to the downside because all this leverage is built up with the assumption of constant inflation, right? So it's not that deflation's bad, it's that deflation's incompatible with the kind of inflationary structural design of this current system. And so that's a transition point. The other aspect there is that um, once certain debts and things like that exist, central bank decisions to either harden the money or soften the money can affect different groups. And an example I cite in the book is the free silver movement, which is kind of one of the original arguments against hard money. And the reason I addressed it is to kind of show what was actually happening here. So basically, in the Civil War era, the United States had a bimetallic money system, so gold and silver. They also printed some fiat banknotes to pay for the war. So now you had greenbacks out there. So you had gold, silver, and you had greenbacks. And these were all dollars. Dollars were an abstract term. And then there was ongoing, some of the people had taken out debt, like farmers and stuff had taken out debt in that unit. And then there were decisions, okay, let's like only gold money. So let's take out silver's money and let's get rid of the greenbacks, which I mean, I like sound money, that sounds good. But if a farmer just took out debt in the prior monetary environment, and now we're changing the definition of what a dollar is to make it harder, and we're excluding things that were dollars, that farmer's like, wait a second. What? No, I want silver to be money. It's like I want more money in the economy to help me service my debts. And so we often, I think we rightly criticize central banks for printing money or governments for, creating a lot of new money or breaking pegs or otherwise weakening their money, which hurts savers and credit owners. But if you have these sharp centralized decisions to change the definition of money from gold and silver to just gold, or otherwise just more aggressively tighten your monetary policy once debt is already outstanding, you're now causing a political schism. You're screwing over those debtors in favor of the creditors, and that's how you get these kind of populist movements that want that weaker money. So my view is not that hard money's bad, but if you rapidly change from a softer money or like a medium money to a harder money, you are making a decision to kind of favor creditors over debtors, which has all sorts of class implications and can result in all sorts of issues. So what I find interesting is that something like Bitcoin has its own unit of account. So in most historical currencies, if you connect a currency to gold, gold itself has no units, right? It's atoms of gold. The units are just kind of unknown to us, and so countries define units of it. They say, okay, this much gold is equal to this unit, which we call a dollar. It's an abstract term. And then we can change the definition of what that dollar is. We can say, okay, now it's worth twice as much gold, or now it's worth gold and silver, or it used to be worth gold and silver, and now it's just gold, right? You can mess with that abstraction. Whereas Bitcoin is just Bitcoin. You can break it into pieces. You can call it sats. For example, there's 100 million sats in a Bitcoin. You can do all sorts of stuff like that. But what's interesting about Bitcoin is it has its own units attached to it. And so it's harder to kind of have these kind of false abstractions on top of it, at least over the longer term. And so I just found that example of history interesting and other ones like it because critics of hard money often use those examples to explain why, in their view, hard money is bad. And my view is not that hard money is bad. It's just that abruptly changing the definition of money while there is outstanding debt, it causes issues, which one would expect.
All right, excellent. Well, Lyn, I could talk to you all day, but unfortunately, neither you and I have all day. So we'll end it here for today. We'll save the rest for next time. Thank you very much. Where can we read your book, Broken Money? Where can we find that book?
You can find it on Amazon, Broken Money, and people can also check out lynalden.com.
Excellent. We'll put the links down in the description below. Appreciate your time as always, Lyn. I'll see you next time.
Sounds good.
Thank you for watching, and don't forget to like and subscribe and follow Lyn in the links down below.